Good morning. Good morning, everyone. This is Bagadon at Stock Market Caddy, and we had been knocked offline due to the stormy weather in Florida for a few days. Our thoughts and prayers are with all those that really got hit by the storm, really across the state. It was by far one of the more dangerous storms, needless to say. Here, we're fine. Thank you for the well wishes. Let's take a look at the markets. They continue to do what they do. Bit of a market hurricane in and of itself. It's Saturday, October 1st at 9:38. And we're going to, as a service to everybody, all of our members, we're going to make a series of videos highlighting some individual tools that we use every day for all of our monthly members in a video format every night. And these very same tools and more are available to our annual members, and you can use them individually, you can use them together. One of our favorite tools is this one called the Nicklaus timing model for the Russell, for the NASDAQ, for the Dow, for the S&P, and then it also has what we call the VIX daily component for the Nicklaus, and it's a contrarian indicator, and we look for it to signal in the opposite direction of the markets. Now, I can say in broad terms how this signal is manufactured. It is based upon the underlying data of each of the futures markets, but it also takes in a data feed of the VIX and the data feed of the 10-year Treasury, the yield on the 10-year Treasury. From there, it goes, those data streams go into a math model, and then they generate a buy or sell signal at the end of the day. Now, it doesn't change from day to day, but when the signal does change, it's end of day. It doesn't occur intra-day. And so if you look at this, the markets, and this is not unusual, all four markets went short on what day? The 20th. The 20th. Less than 10 days, or almost exactly 10 days ago. If you had put on one mini contract, you would be up on the Russell 6,265. On the NASDAQ, 17,735. The YM, an even 10,000. The ES contract, 13,562.50. And then the VIX component did in fact, now these all went short on the 20th. And at that time, the VIX was still short. And we cautioned our members saying that that is an unusual circumstance. It does happen. It usually doesn't last more than 72 hours. We've never seen it last more than 72 hours. Where they're in the same direction, and one of two things will happen. The markets will all flip long, or more than likely, the VIX will flip long in the opposite direction of the short signal usually within 24 to 72 hours. And within 24 hours, it did in fact confirm the short signal. And if you had taken that long with a mini contract, you would be up $3,320 for a collective amount of $50,882.50. Now, if you had used micro contracts, which you can do, you could have used micros here with the exception of this one. This one doesn't have a micro, and you would have been up about $5,000. Now, that is for the aggressive trader. For the investor, IRA investor, long-term investor, this could have been an indication to raise some cash, sell half, sell some covered calls, get some insurance contracts on, suspend your dollar cost averaging, that sort of thing where you could have preserved the capital. The aggressive trader not only preserved this capital, they would have made money as the market was going down. I'm Bagadon at StockMarketCaddy.com. This is just one of the tools that we use that we call the Nicklaus timing model, available on a video presentation every night for our monthly members. and on the desktop for themselves to interpret and to use for our annual members.